All right, Eel Nerds episode 147. This time it is a big mouthful in terms of buzzwords, convertible preferred debentures. And we'll look at a case study and look at that chameleon converting itself from red to blue and eating money along the way. That's like a convertible debenture. We'll learn more. Well, first of all, we are up to 420 subscribers beyond my wildest dreams. Thank you so much for watching. If you're new, please use the playlist called the Income Investing Roadmap. I have also created another playlist. We'll talk about it in a second. Most importantly, I have no magical powers of prediction, and I am wrong. So make sure you do your own due diligence. Well, having said that, we got four different parts to today. The first is to take a look at the market temperature, preferred debentures, and I'm going to talk about my first Bitcoin. Notice the hyphen there. And then I'll review my trades and next steps. My usual disclaimers: I am not an investment advisor. I'm not a wealth management advisor. This is not tax advice, and I don't have any secret agenda. I am sharing my education. Make sure you do your own research. Well, I've been absolutely fortunate year to date to absolutely crush all the indices on my equity allocation, and returning around 21 something percent. And before you say, oh my God, how in the world did you do it? I want you to know that my equity allocation is a really small part of my total portfolio. My total portfolio is predominantly fixed income, where I make about 5.6 something percent after tax. Now here is the actual picture. As you can see, I'm hovering right around the 1.3, 1.4% in equities. I did have a higher allocation during the elections, and that worked out well for me, and I'm back in a hole. In terms of sectors, I am very dominant in consumer staples, like the eggs and bread and things like that. But I am starting to pick up some financials, some healthcare, some IT. How about that? And I'll tell you more about it. I generally believe there's a lot of conflict coming up in the air in the next few months. And so I'm positioning by buying essentials that we cannot live without. And my asset allocation, if you are watching it for the first time, you will know that I'm a very, very strongly fixed income dedicated person. I stay in US Treasuries, a little bit in investment grade bonds, but most of my portfolio is extremely high credit. As a matter of fact, only 0.2% below investment grade, and a very strong cash portfolio that keeps rolling on a short-term basis, because I believe there's a lot more fluctuation to come in short-term interest rates. Having said that, let's talk about convertible preferred debentures. What is it? And why does it convert? What does it mean to convert? Yeah, I'm going to start with the words of an incredible human being, Buffett. And he made a cool 15 billion on his 5 billion investment in Bank of America. And he used some convertible, and he used preferred, but he did not use debentures. He used warrants. And I'll post links to these articles so you can read about how he did it. But that was one of his brilliant strokes. Before I go further into convertible preferred debentures, I wanted you to know that there is actually a playlist that I've created, and I'll put a link to that playlist right there. That is going to review all the convertible preferred related units. And I'm not going to spend too much time on what is convertible and what is preferred and what is good and what is bad. You probably need to catch up on those separately, but I'm going to review them at a reasonably high level. But you will see the playlist called Preferred Stocks. It has 9 videos before this one, so it'll have 10 by the time we are done. And so please watch that if preferred stocks are new to you. So what did Mr. Buffett do? Mr. Buffett said, hey, I'm going to give you 5 billion today. And Brian Moynihan was the CEO then. And I want warrants where I can trade in the stock and pay a fixed price in the future of $7.14. And while I'm waiting, I'd like to get a cool 6% of interest on my money that I give you. And 6% in 2008 was a wonderful return. And I'm doing this because the very fact that I put money into you, Mr. Brian Moynihan, CEO of Bank of America, it's going to make Bank of America look good. You'll look stable, you'll attract more deposits, so take money from me. And there is a separate ticker, because I'm a nice guy. Not only does a portion of my money convert into your stock, at a fixed $7.14, I also will hold warrants to go buy more stock at a specific price. And I can sell them separately, or I can keep them, or I can convert them. I'll decide what I want to do. Well, if you need 5 billion, and if a big name like Buffett comes with it, you're going to take it. And so Brian Moynihan took that deal. And not only did Bank of America do very well, the great Mr. Buffett made a cool $20 billion in that deal. So what does it mean? How did he do a convertible preferred, in his case, warrant, in our case, debenture? And how does it work? I'll give you the 30,000-foot overview. Convertible means, very much like that chameleon is converting from one color to another, the quote fixed income security converts into equity using some formula. And if you looked at all the preferreds, you will know that there is an upper bound, a lower bound, and all of this fancy stuff. But that's why it gets the name convertible. Now, why is it preferred? Preferred means you will get dividends before any of the common shareholders get dividends. And if the common shareholders are going to be stiffed, you are ahead in the line where the company has to use its cash flow to pay you first before it pays dividends to the ordinary shareholders. So that's nice. What's a debenture? A debenture is a bond where once the equity converts, you still have another cash flow, which is the debenture. And the debenture runs for its own length of time, so it's an extra sweetener. So it's not a convertible preferred warrant, but it's a convertible preferred debenture. That is what that is. And now I'm going to talk to you about my first Bit-coin. And for those of you who thought Yield Nerd would go buy Bitcoin, I'm terribly sorry for disappointing you. I'm not a Bitcoin person. I don't even want to pay, give any judgment of whether it's good, bad, ugly. You decide, you do you. NextEra Energy is a national utility. They say they are the largest utility in the country, and they also have the largest renewable footprint. So this is not a small company. They are a huge, dominant company. And they have electricity, they have gas, they have both electric and gas. And as you can see, they are in many, many states where there's a lot of industrial activity. And their underlying stock, however, hasn't really flown off the top. Their underlying stock has kind of sort of hovered around that 80-ish mark. Hasn't, when interest rates started to decrease, they had a little bit of a jolt. When they issued new equity, and when you understand NextEra more, you will know that they are a debt-financed company. As they kept issuing more stock, as they kept raising more debt, they had some trouble with their stock price. But ever since interest rates have started in the path of decreasing, they've been on somewhat of an upward trajectory, but that is kind of where they are. They did say they are going to issue yet another convertible preferred debenture. So what is the case study for NextEra? And on Schwab, this will show up as NEEPRR. And in Vanguard or wherever else, I don't know whether it's going to show up as NEEPRR or NEEPR, but that is the convertible debenture. The par value is $50, but it is trading at $43.41. So there's a little bit of a discount there. And let me tell you more about what the convertible part is, what the preferred part is, and what the debenture part is. To do that, we're going to read their prospectus. And I enjoyed reading that prospectus. It taught me all kinds of interesting things about NextEra Energy. So first, the convertible portion. And here's what it means. Next September, what they are saying is if the stock price of NextEra Energy is below 88, we'll give you a sweetener. We'll increase the preference by 6%. If it is above 111, you made so much money owning this preferred stock. I'm going to decrease the preference by 5%, but clearly the preferred stock would be selling for a whole lot more than $50 that you're not going to be upset at me. That's the angle they're taking. And you kind of look at where they are today and you're like, interesting. Their 52-week high is only 86. So they have not even touched the lower bound. The 5-year high is also barely above the lower bound. And today they are at 77. So you look at that and go, hold on a second. If they have never really even crossed the lower bound, How do I even know this thing is going to be in the money? So the convertible portion, I would say, is not a slam dunk. I would love for the convertible portion to be right around the twilight zone, like maybe they were trading at 87 bucks or they were trading at 90 bucks, but trading at 77 and in a downward trajectory in the last 3 months. I don't know. The convertible portion is not exciting to me. Having said that, let's do the math. One would argue it costs $43.41 to buy something that is going to convert at 50 bucks. Look at that. There is a free 15% money. It's correct as long as it trades between 88 and 111. So in other words, if it went north of 111, then instead of trading at 50 bucks, it would trade at 49.50, meaning it would convert at 49.50. So you lose a little bit if it is north of 111, but on the other hand, it would no longer trade at 43 bucks. It would probably trade at 60 bucks or something like that. So the reality is, if it were to trade above 111, this would be a win, no problem. But remember, today it's trading at 70 something. What if it falls below 88 and it stays below 88? The preference is 0.5626. And as I said, I'm going fast on these concepts because these should already be something you know. If you don't, go to the playlist and understand it from there. But if the price is below 88, then you start getting bit in a different way. Remember, you are paying $43 for something that you think is going to buy 0.5626 common shares. What if the common share is only 50 bucks? I'm just using a simple example. If the common share is 50 bucks, you still only get half a common share, meaning you would only get $25 worth of common shares. And you'd be like, wait a second, I paid 43 for it and I only got $25 worth of common stock. In other words, if this converts below the lower limit, you will lose a lot of money. So here is the challenge. Anything below 77, is going to hurt you real bad. Anything above 111 will hurt you a tiny bit, but you probably are going to win. And if it today trades at 79, I don't know. I don't know if you want to bet on it. You do you. So let's talk about the preferred portion. The preferred portion says, we're very nice people. We're going to give you 4.6% on a basis of 50 bucks or $2.30. And that's given on a $1.15 basis every 6 months. And we'll give it to you. You're nice people. Take it. And not only that, we will guarantee that you will get that 4.6%. We will pledge anything and everything to make sure you get that 4.6%. Thank you, Nextera. That sounds very, very nice. What else do you have for me? Then you go to the sweetener. The sweetener says, not only do we give you that 4.6%, between now and September 2025, we're going to give you another 2.3%. And you go, what? And that is correct. Between now and September of next year, you get 4.6 plus 2.3, 6.9%. Except there is more, this time only. Wait, you didn't pay 50 bucks to make 6.93, you paid 43 bucks, so your actual yield, which is insane, between now and next September is 8%. And you sit there and go, that looks too good to be true. Should I buy everything and then some and make 8% and then convert in September next year? This is the best thing that could ever happen to mankind. And they say, I'm going to give you one more cool thing. And you go, oh my God, this thing is amazing. 10 days before September 2025, you, the holder, have what is called a holder's option. You can say, I will allow my 4.6% preferred yield to be converted into a corporate bond that pays 4.6%. So you can continue that right for another 2 years, or I will take a 2-year treasury if the 2-year treasury pays even more than 4.6%. Look at that. You look at all of that and go, unbelievable. This looks like I'm going to make 8% between now and September next year. And then I can continue to make another 4.6%, and I could convert into shares that may be worth a whole lot more than I paid. How stupid am I to not buy this? Well, Let's do a quick summary. Here is December 2024. Sorry, that should say 2024. You buy at $43. You keep making your 8% bond yield. Plus, remember, you paid $43 for something that in theory would convert at an equivalent of $50 as long as Nextera is range bound between 88 and 111. On September 1, 2025, if you are range bound, you make a killing. You make that extra 15%, you made the 8% yield, and you may go to a 4.6% yield on their own convertible preferred debenture or on a treasury, and you come out laughing all the way to the bank and say, look, I am the man, or I am the woman, and I did it. Well, let's look at it one more time. You buy it at 43, and you keep making that 8%. Nobody can take away that 8%. That's awesome. What if it is not range bound? Let's talk about that. If it is not range bound, then you have a problem. If it is range bound, we already talked about it, the reward is phenomenal. If it is not range bound, let's see what happens. Here is the correlation between NEE, which is the blue line, and NEEPRR. You can tell that they pretty much go hand in hand. So when the stock goes down, the preferred debenture goes down, and vice versa. And then you have to ask the question, how is the stock doing lately? So let's ask the gotchas. You got your preferred for 43 bucks for a basis of 50. You enjoyed that 8%. Nobody can take that away. Let's say that on September 2025, the price was exactly $77.31. If that was the case, then your $43 would not buy $50 of equity, it would buy $43 of equity. And you're going to say, okay, at least I made that 8% yield and I went on to convert. If it is $88 or anywhere from $88 to $111, that's where you're the genius. You made the 8% plus another $6. And if it went north of 111, instead of 650, you make 640, but you still are the genius. And so on the positive side, if it traded at break even or higher, you are the genius. Except, what if it trades below $77? On the same $43, you would lose $4 or 10%. If it traded at 70, you would lose $16 if it traded at 60. And you have to ask the question, what are the odds of that? And I would politely tell you, look at the share price. See if something that trades today at 77 is likely to trade at 88 or more, or is it more likely to trade at 70 or something else? I can't make that judgment call for you. You should. FYI, Nextera said, oh, by the way, we're also going to sell more debt, and we're going to issue more equity units, and we're going to raise another $1 billion. We kind of need that. And the reason we need that, we need it for our general funds. And then they turned around to Uncle, the state of Florida, and said, we worked on all of these 4 hurricanes. It cost us money. So we need to put a special surcharge on our bills, which is very common for utilities. It's good to be a monopoly. And so the good residents of Florida are going to pay approximately 10% more on their bill to fund their hurricane restoration efforts over the next year. It probably will get approved. And so the illustration that I'm making here is they are trying to raise money from Peter. They're trying to raise money from Paul. They're trying to raise money elsewhere. They're issuing new bonds. So there's a lot of financial movement going on there. And Mizuho Securities actually lowered their price target because they said, hey, if the IRA is repealed, because they're getting all this money, stimulus money from the government, and they are using that to pursue some initiatives, if that gets repealed, they won't even make their revenue targets. So we're going to decrease it. 17 analysts say they are going to finish at $88, which is exactly the range bound. So I suppose if you believed 17 analysts, you would go buy. And if you did not believe them, you would sit on the sideline. Surprise, I sat on the sideline. My holdings, and I'll make it quicker. I did buy a whole bunch of new equities, but very small allocations to them. I don't have time to talk about them because I'm already over 20 minutes here. I bought C3.ai. It's a heavily shorted stock. The earnings come out next week. I bought some retail, ConocoPhillips, Flowserve, which is a very interesting play. I think there's some stuff that is going on there with respect to Canada. Canada is a big customer of Flowserve, and my anticipation is that they're going to buy more of it. I bought my first bank, and I bought Federal Signal, which makes heavy duty equipment. And I'm kind of waiting on the sideline to see when the next opportunity is. You do you on fixed income. I'm heavily still on treasuries. Thank you for watching Yield Nerd, and sorry for running over 20 minutes. Have a nice day.